Hi there everybody and welcome back to another stock analysis video. Today, let's actually analyze the company Zoom, a company that, man, ever since 2020 has got so much hype behind it. I'm going to show you guys the graph of exactly what I mean, and seeing that the earnings are actually coming out tomorrow after close, I would like to see if this company's ticker price actually matches the fundamentals. So with that said, let's get started with this analysis. We are going to come right into the calculator, guys. Unfortunately, Zoom does not pay out a dividend, and man, when you see these fundamentals, you will understand why. Ticker symbol of ZM, market cap of $27 billion, PE, guys, of 19.96, which ends up being a share price of $89.74. Now, this PE is pretty much just telling me that this might be a pretty decent buy right now. However, let me just show you guys what this company's graph actually looks like in comparison to what it was, which is now $89. Looking at the graph, you can pretty much just see that this thing had a massive run up all the way, guys, to a high of $557 back in October 12th, 2020. And ever since then, it has completely just collapsed to the current share price of today of $89.74. So this is an instance as to where if I were to have analyzed this company back in 2020, which I didn't because I wasn't making stock analysis videos back then, I would have pretty much just told you this is very much overpriced, and here's the reasons why. And a lot of people would have been like, no, you're crazy, you know, Zoom is innovation, like Kathy Wood. This is one of her biggest positions in her ARC innovations, which I don't understand how video calling could be innovative. I mean, it's just, or disruptive, because, I mean, you have Skype, you have Discord, Zoom, you have a bunch, like WhatsApp, you have FaceTime, you have all these things. So I don't really understand what caused people to think that this company was going to be like the next best thing and it being disruptive, even though there are many other video chatting softwares out there to bring the stock price all the way up to $500. But nonetheless, they do not pay a dividend, which means that the 5-year average free cash flow of $602 million is going straight into themselves to grow the company, pay down their debts, and buy back shares. And man, that is not happening in the slightest. You guys will see in just 1 second. Coming over here now to the fundamentals, starting with, of course, the net income. 5 years ago, guys, look at this, negative $3.8 million to 1 year ago, guys, look at this, 1.3 or essentially $1.4 billion. That is an increase of 36,300% on the 5 year. This is absolutely insane. So you can pretty much just see what I meant by hype, right? I mean, for the past 5, 4, and 3 years ago, they went from what, negative 3.8 to positive 7.6 to then 25.3 million, and then all because of COVID, and people were, you know, chatting online and all this stuff. They went up to $672 million, and then 1 year ago they shot up all the way to $1.4 billion. This to me is the definition of hype. This to me is the definition of there is no such thing as actual fundamentals when it comes to this company, because this is not sustainable. There is no way that this is actually sustainable with all the competition that Zoom has. It's a video chatting software. You can't expect me to believe that, especially now that people are actually starting to go out more. Essentially, all COVID regulations are essentially gone. You know, I can't expect to believe that this company's net income will be higher this year than it was 2 years ago. It's just, I refuse to believe that. So you will probably see a big decrease within this year and to the years to come. And just like the net income, we see similar thing when it came to the free cash flow. 5 years ago of $9.7 million to 1 year ago, guys, of $1.5 billion, increase of 15,082% with a 5-year average free cash flow of $602 million. So once again, we see the exact same thing. Pretty much not that good from 5 to 3 years ago. However, 2 years ago it shot up to 1.4 billion, and then 1 year ago 1.5 billion. Yeah, this is essentially, these two numbers right here are skewing this 5-year average. This 5-year average shouldn't be above what, $50 million or so. So another instance as to where this company is actually heading to. In my personal opinion, there is no way that they'll be able to continue this because it's just not feasible. This is way overhyped to no end, at least when it came to the cash flow. They probably did make a lot, don't get me wrong. A lot of people were using their services. However, understand that now things that are coming back to the way they were, Zoom isn't the only company out there. You have Skype, you have Discord, and other ones that I have said a couple minutes ago. Coming now to the revenue 5 years ago of $151.5 million to 1 year ago of $4.1 billion, increase of 2,606%. Once again, very, very similar to what we have seen. Nothing, and then shot up 2 years ago to $2.6 billion, and then 1 year ago it's $4.1 billion. I have said my piece with this, moving on. Coming now to the total assets minus the total liabilities. If they were to liquidate all of their assets, guys, would they be able to cover their liabilities for starters, which includes their debt, and by how much? Now, this is something that I definitely have to give them credit for, is that within those 2 years of COVID and all this stuff happening, they shot up this difference by a significant amount in the positive direction. So currently they're at what, $5.8 billion in assets minus liabilities, and within the past 5 years they have increased it as well. Average total assets is around 3.7 billion, average liabilities is around 953 million, and doing this difference we get around $2.8 billion. And now we come to, oh boy, now we come to the metric that when I saw this, I don't even know what to say. The shares outstanding. Okay, this metric, guys, is really, really important. This is the one that tells you whether or not the company is diluting you as the investor. You want this company to be buying back shares and not issuing. And as you can see right here, they're issuing shares only by a little bit, but a slightly like little bit amount. 5 years ago of 82.6 million shares to today of essentially 300 million shares. That is an increase in the 5 year of 262%. And from the previous year to the current year, we're looking at 2 years ago, so when COVID happened, to 1 year ago, they increased it by almost 2%. So as it stands, guys, you may disagree with me when it comes to their net income, their cash flow, and their revenue, saying that, oh no, they might continue to go up in the future, mainly because COVID gave them notoriety. However, as an investment, this right here is the biggest downturn for me ever. I'm looking at this, I'm just like, this is not a small amount in the slightest. This is complete share dilution of the investor. Now, my thing is, can you really blame them? Their shares went all the way up to $555, okay? So they were probably looking at this and they were like, let's issue these shares. It doesn't come at any expense to us. Let's issue these shares and get this money to pay down our debts, which is probably why you see their liabilities shoot up, and essentially not shoot up, but start to go up 3 years ago, right as they started to issue shares as well, and then continue to go even farther up the more shares they issued 2 years ago, 1 year ago, and up to today. So as it stands, yeah, just this alone, this to me is just like a hard no when investing into this company. And lastly, looking at the cash equivalents, they currently have around $1.1 billion with an average cash of around $791 million. Now let's come over here and make some assumptions. Low, medium, high, using 3 different factors: revenue growth, predicted share buyback, and the required rate of return. Guys, revenue growth, I like to use Seeking Alpha's growth tab, looking at the revenue growth year over year and the revenue growth forward, and making an assumption between those two numbers. For the predicted share buyback, we just saw the shares outstanding graph, so I'm going to be using that as a reference. And for the required rate of return, keep it flat at 10% across all assumptions. Now, for my lowest assumption, I'm going to say a revenue growth of 5%. If you guys see the revenue growth year over year and the revenue growth forward in Seeking Alpha, you can see that it's very, very high. I personally do not believe that this company will be able to grow that high into the future because, again, a lot of competition, and it's only a video chatting software. I don't see how they'll be able to get more revenue into the future with all this competition with like Apple, Microsoft, right? All these other guys. So with that being said, I'm going to put my revenue growth at 5%. For the predicted share buyback, guys, I'm going to put it at negative 14%. This means that they're going to continue to issue shares within the next 4 years as well. They do have precedent for this. They have been issuing shares, so I think that they'll continue to issue shares down the line. So with all of this said, this gives us a target share price, not adjusting for debt, of $36.26. For the revenue growth, I'm going to say 8%, predicted share buyback of negative 12%. This comes out to be $40.95, and from a highest assumption, revenue growth of 11%, predicted share buyback of negative 10%, this comes out to be $46.14. Now let's adjust for debt. The way we do this is we take the cash equivalents and we take a look at their net debt, and if they have more debt than cash, this number comes down, and if they have more cash than debt, then this number comes up. And as you can see, it does come up for the lowest assumption to $75.61, for the median assumption $85.05, and from a highest assumption $95.51. Now, me personally, I like to add a margin of safety, 5, 10, and 15%, just so that way we can cover all bases and you don't overpay for something. Now, in doing so, I personally would like to buy between $64.27 to $71.83 for the low assumption, and for the median assumption, between $72.29 to essentially $80.80, and lastly, from a highest assumption, $81.18 to $90.73. Guys, the current share price is $89. So as it stands, you know, if you take into account essentially my highest assumption, then we are there, right? The highest assumption, target share price, adjusting for debt, then we are essentially there, and also adding the first margin of safety. However, everything else, it is essentially still way too expensive. And again, this company has already fallen from $500. So for all of you guys who might say, oh my God, this can't fall to $36, that's insane. Well, understand that has already fallen, what, $400 plus, more like $500 plus. So the fact that it can't go to 36, I find that a little bit insane, right? It absolutely can. Now, will it? I personally think that the correct answer is probably between the median assumption and the high assumption. So between $85 to $95 for the target share prices, and $40 and $46 essentially, somewhere between this range. But then again, it really just depends up to what assumptions you make. For example, let's say that you don't agree with me. Let's say that the revenue growth, you think that it's going to be, I don't know, 20%, and you think that they're actually going to start buying back shares at like 2%. Well, as you can see right here, this changes pretty much everything. Right now, at this point in the game, the target share price after debt is $142, which at that point it will be an absolute buy. Do I believe that that will happen? I don't believe so, mainly because of what I just said before. But nonetheless, guys, this is just a way to show all of you guys how to invest using a process. That's why I have this calculator available for free. Anybody can have it. It's in my calculators playlist, and there's a whole entire thing of like how to use it, set it up, and all that stuff. You guys can have this calculator. I also have a book value one as well for the companies that don't have capital expenditures, and a dividend tracking sheet, all for free. All I'm asking for in return, guys, is like, subscribe, comment. It really does help here. We've made it above 600 subscribers. Thank you all so much for everything. I really, really do appreciate it. We'd love to get to 1,000 by the end of the year. And again, this is not financial advice. This is why I'm giving these out for free. All I'm asking for is 30 seconds of your time to help me grow my channel. That's pretty much it. All in all, guys, when it comes to Zoom, this is a company that is overpriced. I don't see why it got to 500. I really do not see that. And the fact that it's at 89 now, it might be considered a good price right now. However, they have a lot of negative stuff against them. For starters, I don't believe that they'll continue to grow their profits in the manner that they did 2 years ago. Now, that could be subjective. However, what isn't subjective is how many shares they have issued within the past 3 years. That is absolutely insane. So just that metric alone is already turning me off to this company, and I just don't really see it as a good investment in my personal opinion. But you guys can do whatever you want with your money. See what this calculator gives you using your own assumptions, and you decide for yourselves. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You guys can follow me on my new tech sites at BitChute, Odyssey, and Rumble. Also have a Let's Play channel on YouTube and Rumble. The links are in the description. Currently playing Stardew Valley with my girlfriend. So if you guys want to see that, you can follow me there. With that said, peace out, and I will see you all in the next stock analysis video.